Hi, it's Jeffrey Cohen. Good morning. It's September 29th. It's 7:42 Chicago time, 8:42 New York time. We're here to talk about the markets. We're here to talk about how the stock and the bond markets did yesterday and how they look like they're going to do today. We're also going to walk you through our our new fund and some of the lessons learned and some of the things that are important based on what we saw yesterday. We may share a little inside baseball too with our model run. The most important thing is market went up yesterday. Let's see if I have a simple way of showing you that. Market did great. I mean, as long as you were like maybe looking. So this is FinViz. I'm sorry, I'm moving things around a bit this morning. See, I got my run right here. It's interesting. So, market was up. Market was up almost 2%. Most stocks were up. This is a pretty amazing day because we've had like 10 days in a row of down. But a few important things to point out, just in case. So, market breadth is very, very weak. New highs, and it's early. It was just one day up. So stocks, 34 new highs, 693 new lows. We take a look at the FINRA site, which is helpful. And we see 31 new highs on corporate bonds. And we see 2,242 new lows. That's also a pretty tough day in the markets. That doesn't happen by accident. That is a tough day. That is rough. That is rough, and I don't like it. And so that says a lot, right? So when we look at what else is kind of relevant here? Yeah, yesterday, right? So everything went up. It's great, right? Small cap went up more than large cap, right? So market barometer was very strong. But if you look over 1 week, 1 month, 3 months, 1 year, it's been tough. It's been really tough. So we had a good day. That's how I would look at it. We had a good day, right? Take the good days, especially if you're a long-term investor. These good days are very helpful. Now take a look at the Treasury yield curve, where it's coming up at the 2-year, very high on the 2-year, 4.07, and then it came down to 3.70 on the 30-year. So that is an inverted, somewhat inverted yield curve. Although, to be honest, when you talk about an inverted yield curve, you really talk about when short-term, 1 month and 3 month money jacks up higher. And it does that when there's a liquidity crisis. As an example, Bear Stearns, Lehman, Merrill, all going bankrupt. Short money goes through the roof because they've got to borrow, they've got leverage. You saw it in England yesterday. Pension plans had bonds that they had to get rid of, or they wanted to get rid of because they were down like 50-80%, and there was no market for them. There was no money in that local UK market. It's not like Jeff Cohen, Chicago Quantum, is going to go put money in Europe. We're not. And so there's no market, right? And so a lot of times the central banks have to make a market, but you see it here first. You see short-term money jack up higher. So we don't see that now. Everything's fine. Nothing bad happened in the market. Market had a good day. Everyone should be pretty happy. Market went up. Oh, look, market went up. Dow's up 1.88. Right, and there was no, although the NASDAQ did fall in the last, 15 minutes, and the S&P fell in the last 15 minutes, it didn't want to have all the gains. But to be honest with you, when we look at our model, so the stocks that we picked yesterday, so the first 4 are shorts. they went up. That's not helpful. Then the S&P 500, yep, went up. And then all the longs went up, but they went up a lot, like 6.3, 7.5, 6.7. So we actually made money yesterday in the model. We're going to talk about that. We're going to talk about how on a great day like yesterday, we actually made less than other days which were less stellar, right? And now we look today and you see the S&P futures, they want to give back all the gains from yesterday. Now, I don't know how accurate these futures are, but look at that. 1.5% down, 1.28 down. NASDAQ futures, 1.9 down. The Russell down 1.92. So I see that. I see the US dollar actually strengthening. I see silver falling. I see gold falling. Those don't bother me. Crude oil, flat. I'll tell you what I'm looking for. The Japanese yen, about the same. It's about the same. The VIX is down, which is interesting, although it's creeping back up. So less risk, less worry about downward movements. So what are we at? We're at a 10-year Treasury yield at 3.81, 3.82%. Now this is going to define the market today. This is it. It's U.S. Treasury yields. Full stop. Full stop. And I'm going to show you something else. We have a set of banks that we like. We love these banks. Oh, yeah. Going to make lots of money betting on these banks. But if you look, the thing that's really important is the 20-plus year is down 1.5%. Mortgage-backed securities, it's hard to know, right? They don't really trade. But you look at regional banks, down 1%. Regional bank ETF, those are U.S. regional banks down. You don't really see the futures moving and the yields moving. But what we do see is if we look at it a little bit differently, we look at summary. You see these are live. And you see that the bonds themselves, the 30-year, the 10-year, the 5-year, the 30-year, the 10-year, the 5-year, the 2-year, and then you see yields, 30-year, 10-year, 5-year, 2-year, 3 months. Those yields are, so the short is going down, but all the long are going up. So we're back to a normal yield curve. This is going to change everything in the market. This is going to drive the market lower. So dividend stocks, down, big, right? Interest rates, up, big. It's going to change things. So it's like we had a flip-flop yesterday to today. And so our model, probably the stocks that we're holding, and I'll explain the changes we're going to make. If we look pre-market, by the way, are we at pre-market here? No, let's find the let's go to the pre-market view. That's a new view by us, Chicago Quantum, proprietary view. Pre-market, oh look, it's all red. The shorts are red, the longs are red, except for one short and one long. Red, red, red. So my guess is, if I look at some of the other hotbeds of industry, money managers, pre-market, red, wow. Except for AllianceBernstein. Who knew? Who knew? Maybe they're an acquisition target. I don't know. Pre-market on the retailers. CarMax is down. Rite Aid is down. Carvana. Those were your risky ones. There's a lot down, though. A lot of negativity out there. That's what I say. Dollar Tree looking good. Interest rates go up. Shop at Dollar Tree. I don't mind. I love Dollar Tree. I shop at Dollar Tree. I love Dollar Tree. I just want you to know that. I love Dollar Tree. I do. You may not like it. It may not be your thing. It's my thing. I just love a bargain. I got to tell you. It's like Verizon at $38.50 a share. Love a bargain. Got to buy more. Okay. Let's take a look at your Bitcoins are down. What's interesting is your physical miners are down. Cleveland Cliffs looking good though. Cleveland Cliffs. I got to tell you, look at that. Steel Dynamics, Nucor. So what this is saying is economically we're going to be fine. There's no recession. Steel, Rio Tinto, Vale, all looking good. So that's interesting. That's kind of physical economy coming back. And let's take a look where we like to play, which is in the computers, chips, and telcos. Wow, is this a terrible day in that market? This is like real economy, real tech, right? Telco, down. Manufacturing of computers and hardware, software, down. Services, little bit, not much. Down. Everything's down. So, it's not a good day. Now, who knows, right? Are the futures going to stay there? Are they going to get better? We don't know. So, now we're going to switch gears. We're going to take a look. What's our model say, right? And so, we run our up run. This is live data now. You would have paid $750 for this run. This plus all the text. And you see the model is moving riskless. Riskless. Berkshire Hathaway, P&M Resources, Microsoft, Marsh & McLennan, Physical Gold, BlackRock, McDonald's, Ameriprise, Apple, Pepsi. So the model says if you're just going to buy one stock and you're evaluating risk return on one stock at a time, you got plenty of low risk stocks to buy today. All day long, you load up on Pepsi, Honeywell, oh my God, Yum Brands, Johnson & Johnson, Coca-Cola, Illinois Tool Works. You know, who doesn't love a tool manufacturing company? You know, tool and die. Lincoln Electric Holdings, Mondelez. All right, I'm falling asleep here for all these low-risk stocks that the model has picked. If you want individual stocks. Now, on the down run, where are we at? The down run's got a lot of pharma. Pharma is in the doghouse. Pharma. AMC Holdings, Everbridge, which is not pharma. Pharma, Snap, Peloton, pharma. Tellurian, liquid natural gas. Probably going to go up today because they blew up the pipeline yesterday. Who knows? Pharma. I'm going to throw up. And then IonQ, which is a quantum computing company that we're following that we like. And so the model would say, if you're going to short, you should short one stock. You shouldn't short many stocks because you diversify out all of your goodness, right? And so I guess if you're going to pick one stock, you could take your pick. In our hedged fund, we take three because we actually do want to reduce some of the risk. So this is, we're just going to save it because we colored it for September 28. This is close of business yesterday. So that's interesting where we're at. So where did the model say to go? So what it said was, so first off, let's look. How did we do yesterday? Yesterday, day 9, right? So how we did, so fascinating. I love having a hedge fund. Why not, right? So the P&L in dollars yesterday was the longs went up $500. Now, how much long was there? It was 4.8% return in one day. So the market really screamed, right? $500 up, but your one-on-one S&P 500 hedge gave back $190 of it. Your beta-weighted S&P 500 hedge gave up $435 of it, and your CQNS downrun gave up $401 of it. But the truth is, you still made money. You made $100 in a day. And it shows you percentage-wise, right? You made 0.9% in one day. That's really great. And so now the model does better other days. So on a really down, crappy day, Monday, the longs lost $266, but the shorts made $584. What's interesting is the beta-weighted hedges didn't pay for the loss of the longs. But on this day, your beta-weighted hedge paid for your loss of the longs. Here you see, you lost all around. But on this one, you see you lost $650, you made $1230. So you have days where your CQNS downruns just dramatically outperform, right? Here you made money both days. Here you lost $44, but you made $737. Now, it's not to say that we're loading up because we dollar cost average up and down, and we actually swap positions based on the model. But you can see you make a ton of money in this model, but today you made a little bit of money, or yesterday you made a little bit of money. What's interesting is it takes a while for the cash balances to catch up and for the net asset value to catch up. Because we actually manage the model on a cash basis. So let's take a look at what we're buying and selling today. This is totally inside baseball. Jeffrey, what is the Chicago Quantum net score doing today? So we are buying DDS, which is Dillard's. 1 share. Okay. We're shorting S&P 500 index ETF, 1 share even, or 3 shares on the beta weighted. We recalculated our beta weighting and we're at 2.28. That's our new beta. We redid every formula to check. We went through every stock, right? We actually go through our run and we look, and we have beta values for every stock, and we're able to go through it, and we're able to take a look at where we're at with every single stock. Well, that's not helpful. See that little circle thing? This is an Apple server. It should not be dogging like that. That's not helpful. All right. So our shorts, we have to short more, but not many shares. Look at that. Not many shares. 2 shares. 11 shares, 30 shares short. So this is going to be a very, very easy morning because we're shorting like 50 shares of crap, like $10 a piece. We're buying 1 share of stock and we're shorting 3 and 1 share of the spider. And so what the model effectively is saying is stay the course. Don't change. And so I just find this super interesting because now we're going to find out what happens, right? Like the market looks like it's going down. Where are we at? And so let's go back to FinViz. We got a half hour before market opens. We could spend a little more time here. Crypto down 1.5%. That's not bad. It's at 19.2. Remember we talked about the $20,000 support level? Yeah, you're still there. It's not really moving. We talk about currencies. The euro is down, so the dollar's stronger. The Great British Pound is still pretty weak. The Japanese yen, interestingly enough, I think Bank of Japan is working hard to do quantitative easing, selling off dollars, which they likely have, right? Or U.S. Treasuries, which is interesting. We didn't even think about that. But Japan might have actually sold off, which would have driven up yields. No, I don't know. They might have sold off some UK stuff too. But that's interesting. We don't know that for sure. But we like to look at this stuff, right? Like, where are we at? Where are we at here? So if we look, most currencies are down against the dollar. Dollar is strong. Dollar's strong. All right. How are we with the futures? Well, dollar is very strong, by the way. It's up 0.5%. How can a currency be up 0.5%? I remember when I first looked at getting into this business, currencies would move like 0.05%, 0.1% maybe on a big day. By the way, you never had 30-year bonds moving 1% a day. 30-year bonds, 10-year bonds, normally everything, it's like a calm. My wife, we were talking last night and I was explaining to her what happened in the UK. And I said, honey, just imagine you buy a 30-year bond, Archer Daniels Midland, okay? Or you buy an IBM bond, right? Or a treasury, U.S. Treasury. And all of a sudden, I'm like, oh, honey, the bond is worth half of what it used to be worth. What? I thought bonds were safe. So she said, I thought bonds were safe. And I said, well, in a way they are, because the bonds we would buy would be a U.S. savings bond. Or we might buy something very short term, a CD, something short, right? A mutual fund. But this is a 30-year bond is valued based on the cash flow of the interest payments. And so as the discount rate or today's interest rate goes up, those cash flows are worth less. If you look at the mortgage-backed security market, it's even worse. Because not only is your current bonds interest rate worth less, but there's new bonds being created, being securitized at a higher interest rate. They say interest rates now are around 7% on mortgages. We're going to take a quick look at that. But for right now, take a look at that. The 30-year bond is down 1%. The 10-year is down 0.7%. I don't know how accurate or how timely these quotes are. It doesn't matter. They're directional. The VIX is up. It was down on another website. S&P 500 is down 1.2%. Again, I don't know how accurate. Crude oil, up. Gasoline, flat. Copper, coming back to the 350 number, which is interesting because 350 for us is the touchstone for copper. And so economy, right? They're saying, oh, it's fine. It looks good, right? Silver's down. So let's take a look. Where are we at? Let's take a look. Let's find another place to look for the bonds. I think the bonds are a big deal. So let's go back to Treasury yields. This is the 10-year, 3.80. Let's go here. We're also going to look at mortgage-backed securities real quick. But for right now, I've got two mutual funds. We're going to stay here. So and the mutual funds wouldn't have traded, right? So they're going to show you yesterday. So this is all yesterday's close. But what's interesting is, take a look. Your 30 years at 3.758. Your 10 years at 381. Your 5-year is at 4.04, and your 2-year is at 420. And those are all up, which means the bonds themselves are going to be lower. Where's my mortgage backs? Where are my mortgage rates? By the way, we're going to see if the Fed did any tightening this week. Oh, yeah. You know I look every week. I only update the data once a week, but I look every day. Because I just want to be reminded of how crappy our Federal Reserve Bank is doing when it comes to tightening the money. Sure, you could raise interest rates. But show me that you know how to sell off debt without destroying the market. And then I'll show you a Federal Reserve Bank that is technically skilled. So let's look at the mortgage-backed security prices. So you can see when we first started showing this to you, this is very important. Couple things. First is the 30-year fixed rate mortgage, because rates dropped yesterday, the 30-year fixed rate today is down to 6.65%. That's great. However, mortgage-backed securities are significantly weaker today, so you're going to see higher mortgage rates by the end of the day. So when you go to your bank and you say, oh, what's your mortgage? You're going to be grabbing new sheets of paper and saying, oh, no, interest rates went up. I'm so sorry, Mr. Cohen, but you're at that 30-year fix that yesterday you could have locked in at 665. Now it's 690. I'm so sorry, Mr. Cohen. Because take a look, and you were doing 4.5. You were probably at some point doing 4% MBSs. Then you were at 4.5 to 5, and now you're 5 to 5.5, and the 5 to 5.5s are down. I bring this to your attention because these mortgage-backed securities are being held by pension funds. They're being held by financial institutions. They want to carry and earn the interest. But instead, they're taking a huge loss on those bonds. Just a tremendous loss on the bonds. And look at that. We are September 29. Jeffrey, how many days are there in September? You know, I don't know. Oh, look, there's only 30. 30 days has September, April, June, and November. All the rest of 31 except for February, which is 28, and on leap year is 29. So 30 days. That means we have a day, 2 days before the end of the second quarter. 2 days. 2 days. And look at the mortgage-backed securities in the toilet. Show me your treasuries, Jeffrey, and I'll show you in the toilet. Let's go look at the 10-year, and let's go look at the 30-year, and let's go look at the 5-year. And Jeffrey, tell me, how have we done this month? How have we done this month? How have we done this quarter? Let's look at 6 months. So if we go to June 30, on June 30, we were at 118.50. Now we're at 112. We're down about 5% on the 10 years. So if you were holding 5-year bonds, you're down about 5%. Now this is a Treasury bond future, so this is 30 years. Where were we on June 30? On June 30, we were at 138.60. Now we're at 138.60? Oh my God. 138.60, and now we're at 126.40. It's down about 8%. Oh, Mr. Cohen, I'm so sorry. Those 30-year bonds that you put away to save for a rainy day, they're down 8%. Might as well hold Snap, Peloton, AMC, and what is it? Evergreen, or whatever the hell that crappy stock is. Yeah, Mr. Cohen, you're down 8% on your bond in 3 months, but you could have held Everbridge or AMC or Snap or Peloton or Tellurian or IonQ. They might actually be less risky than your 30-year bonds right now. Just have me vomit all over you. It's so disgusting to even hear you talk like that. How we doing with the 5-year? Jeff, at least tell me the 5-year is a safe haven, right? So 30-year, you were at 112.6. Now you're at 107.5. So you're down 3.5% for the 5-year. So there's no place to hide. Mortgage-backed securities, Jeffrey. Let's go with the 5-year. I like the Ginnies. Actually, do you know I'm holding some Ginnie Mae funds? How we doing? Ginnie Mae paying 5%. If you held it in June 27 is the best I can do. June 27 closed at 102.60. Yesterday, 97.80. Fuck. You're down 4% a quarter on mortgages. And that's no defaults. There's no defaults in the market. I'm not hearing any defaults. And now let's take a look at corporate bonds. Jeffrey, talk to me about corporate bonds. Maybe all this government stuff's crap. Let's look at the corporates. So we're looking at FINRA. By the way, FINRA, we love FINRA. FINRA regulates us as an investment advisor, and as an investment advisor representative, we are under the auspices of the SEC and FINRA. And let's take a look. Investment grade bonds. Who doesn't love investment grade bonds? Safe, right? Sound as a pound. By the way, the pound isn't safe anymore, right? It's gilt edged. Oh wait, UK bonds aren't safe anymore. So, how about corporates? What, Jeffrey? 6,200 fell, 1,700 rose. No. Opposite. I'm so sorry. I'm such a not focused. No, bonds did great yesterday. 6,200 rose, 1,650 fell. Bonds did great, but if your bond was already down, 17 new highs, 1,515 new lows. So if your bond is down, it's down. So now we're going to take a quick look-see at our favorite stock, Verizon. We are long Verizon on the equities. We don't own the bonds. But if we take a look at Verizon right now, and we want to see how did we do? How are the bonds doing? So I look at this every day, and I did a run yesterday. I did 4 miles holding 10 pounds in each hand. I was sweating buckets. It was awful, right? And I thought about this fact. Verizon is buying back. Verizon generates about $5 billion a quarter in free cash. And they're using about $4 billion, roughly, to pay back debt. That's about $50 million a day. And you can go into Trace, which is this database, and you can look and you can see how they're doing. Now, when you see two trade notices, and this is for today, this is this morning at 8:12 Chicago time, 2 minutes ago. When you see two trades like this, what it means is that the buyer and the seller reported. So usually it's a retail buyer and it's a broker-dealer seller, and then the broker-dealer as buyer and some other holder as seller, unless they were selling out of their own inventory. And so you don't look at those because that's retail trade. So $1.3 million of the retail trade wants to earn 5.3% 2027 maturity. That's great. And then you got a guy here for 15,000, 25,000. Not that interesting to me. This gets interesting. 2028, $1.85 million. So 2028 says someone is buying up some of the shorter term maturities, It's only a 2.1% interest rate, but they got 15% discount on the buy. They'll take it. Okay? 1.8 million. You look, there's 480,000 again on the 2028s. Someone's buying up 2028s. Right? Now that's nice because that's 6 years from now, right? And it was probably like a bubble of bonds, right? 2.1% interest rate. So Verizon, if they're buying these back, isn't going to save a lot on interest. But they're getting a 15.5% discount on relatively short-term money that they might have to refinance in the next 5 years. So here's more money. 2028. This is 4.329 coupon. They got a 6% discount. But they took 2.2 million. Look at that, same number. Oh, no, that's probably a buy and sell. Or they bought twice. We can look at tab 2, it's okay. So, interesting, someone's buying up to 2028s. Here's 2.8 million, 12% discount, 3034 debt. 5 million plus. 2043, but they're getting rid of a 6.5% coupon over $5 million. It could be $20 million. We don't know. They paid extra. They paid over par, but they eliminated high-yielding interest, high-yielding debt. That's terrific. If you're, here's another one. 800,000, 3% money, 800,000, 5.8. I look, there's a spreadsheet they publish every quarter where you can get a feel for where the pockets of liquidity are in their debt. I just find this so fascinating, right? Because this is yesterday's trade, so we don't want to look at that. We want to stay with today. And so what we do is we look every day and we see where's the flow here, right? So you see 2043, they picked up some high yield debt. Not a lot of purchases this morning, right? Maybe it's because it's Thursday. Maybe the guys are coming in a little later. But we notice throughout the day, you're going to find about $40, $50 million of purchases that are only one side of the trade reported. They're only reported by the seller, not the buyer. Because the buyer, we believe, is Verizon. 50 million bucks. Now, in this case, you see they picked up 6.5% debt. Just imagine for a minute, $1 billion reduced at 5% yield, 5% coupon, is $50 million a year. So $1 billion is like a month. So for a month, they buy up some bonds and they're able to eliminate interest payments of $50 million a year. You do that over the course of a year, you might be able to eliminate $600 million of interest payments, which goes right to your bottom line as net income. We love the fact that Verizon profits right now paying back debt during this market. And when we look at interest rates and we look at the actual price of the bonds goes down, it means Verizon just makes more money as they buy them back. Now, this assumes Verizon will continue to make cash flow. It assumes that Verizon continues to use that cash flow not to pay dividends or to buy back stock, but actually to pay down debt. It assumes that they could manage their capital structure and their capital expenditures for their network, both 5G and legacy. It assumes that they don't inflate their operating expenses and pay the union a nice big fat 10% raise and blow the $4 billion. It assumes a lot of things. But in general, they got money. They're buying back debt. And you see it. They bought back 6.5% debt. I love those guys. So how's Verizon doing? I bet you they're in the toilet right now because interest rates are up and everyone says, oh, you can't buy Verizon. You can't buy any of the telcos when interest rates are going up. In fact, you can't buy any of the tech, right? I don't believe that. I don't believe it for a minute. I believe Verizon is a screaming deal, and I believe at 39 and a quarter, you should back up the truck. By the way, you know what else I'm thinking? I'm thinking I might have been short-sighted. I'm thinking you pick up a little Dish, a little Charter, a little Comcast, a little AT&T, and God help me, a little bit of T-Mobile. And while you're at it, you pick up, I can't say it, I'm sorry. Oracle, Cisco, IBM, HP, Dell, HP Enterprise, NetApp, maybe even a little Lenovo. And you start betting on a future expansion of our economy, a future expansion based on tech, based on hardcore tech. I know that's like the stupidest thing, Jeff, you've ever said. And it probably is. But at least for now, right now, telcos are on sale. May not be a bad time to buy. And so that's so interesting. So I want to thank you guys for watching. We got to get ready to trade the market. So what did we tell you? So let's take a look. We told you that our money management system is maintaining a very fat cash balance. Fat. Our long investments from earlier 2 weeks ago are down about a third. In fact, they're down almost 50%. So as the market has said, get more risky, risk on, we're putting less money at risk. While we're putting less money at risk, our hedges come down a little bit too. We are actually making money in this market. We love it. The model works. And today, there's really no change from yesterday. So you're going to just play it out. The model says just play it out, right? And then when we look at the market, we see it's red futures. It's a really tough day out there. But largely based on interest rates. Look at those interest rates. Mortgage-backed securities are in the toilet. Now what's funny is corporate bonds went up yesterday, but corporate bonds most likely going to be down today. Interest rates are going up. Corporate bonds are going to be going down. Look at that. Again, who knows how timely. We have some live data sources that we can show you, but we really shouldn't be showing you because we pay for them. But you're down 0.75%. You're down 0.5% on the 10-year. You're down 0.6. This is the bonds. You're down 0.75. So 0.8. So interest rates, that's interesting. It's recovering from first thing this morning. Who knows? Maybe it's hard to know what's going to happen here, right? It's a real, but I would watch the interest rates and then I would look at the equities, not the other way around. All right, thanks for watching. If you liked the video, hit the subscribe button, drop a comment. We love it when you comment. We'll respond. Tell your friends, share the info. If you want to learn more or if you want to watch kind of how we're doing, we have a website, chicagoquantum.com, and there's a tab, CQNS Market Test. And if you go to that, we tell you today what we did and how we're doing. How did we do yesterday, a very green day? And we share very, very detailed specifics. What are we trading today, right? So it was important to share this with you because of what happened, different compromises we're making. And then we talked about yesterday, it wasn't easy being green because we were risk on into a risk on market. And so we were nervous. So we shared it with you in a blog. So thanks again for watching. You take care now. And good luck.